Good afternoon. My name is Joe Terril, president of Terril and Company, independent wealth managers in St. Louis, Missouri, with approximately $725 million in discretionary assets under management. Today is Thursday, December 17th, and we wanted to update our thoughts on the economy and investment markets. And appreciate you joining us today. And as always, helping me is Brian Curtis. Brian, thank you for your help. And if you're ready, Brian, we will start talking about the economy. Everything about the economy, potential world economy, and investment markets has been incredibly volatile during 2015. We are still bullish on the world economy. The price of almost all raw materials, whether it's the price of oil, the price of iron ore, the price of tin, you name it, prices have collapsed all over the world. This is going to take a transitionary period of suppliers pulling back, and we may even see some bankruptcies of people that are in these businesses of quote-unquote commodities. And that may, for a while, sit heavy on the world economy. But in the broader picture, these things are all very good for the world economy. Cheap, abundant energy prices is good for the world economy. Very cheap, lowest prices we've seen sometimes in as much as 25 years is very good for the world economy. So I continue to believe that we're going to see economic improvement from Europe. The United States economy should continue along with 2% type growth. Economy in China should continue along at 6% growth. The balance of the world will probably continue to be no growth to slightly negative, but put that together and it spells a reasonably good economy for the world as we look a little bit at the broader picture. Transitioning to there in the next 6 months, economically, it'll still be okay, and the world economy isn't getting ready to collapse. We are not getting ready to have a worldwide credit crunch. We're not getting ready to see a severe worldwide recession. So we feel good about the longer term outlook for the world economy, and particularly with very low to non-existent inflation, as well as what's happening with material prices, and particularly energy prices. Not good for those that produce energy, not good for economies like Russia, where they're overly dependent upon energy as a means of earning income. But for the balance of the world and the balance of the rest of us, this is very good news, and it will be good for the economy as we get into the second half of 2016 and as we move into 2017. So Brian, if you will, let's move to maybe specifically talking about investments and how this collapse in commodity prices and et cetera is affecting the investment world. Okay. Brian, I got a question for you. How long do we have to talk about investments? Can I talk an hour and a half? Will that ruin our normal approach here?
Probably run out of time there.
Well, I say that in jest because I think I could talk for an hour and a half about why the markets this year in 2015 and even yesterday and today have been so volatile. We're up 400 points, we're down 300 points. We have a real tug of war going on, but let me maybe start and just try and make a few points for what time we have here. Any of our clients, please feel free, if you want to talk an additional length about this, feel free to call me and we can talk on the phone, but I'll try and explain what I can on our podcast here. First, yesterday the Fed increased interest rates by 1/4%. They're talking about next year maybe increasing 3 times, maybe 4 times more at 1/4% each. That is, in the scheme of the investment markets, that's not important. It's not going to have a major effect on investment prices, and it really is unimportant news. As I've said before, what the Fed is really doing is not tightening up on credit. What the Fed is doing is becoming less easy on credit. At the end of the day, they're still going to be in an accommodative, easing mood. With that said, part of this issue about the Fed increasing interest rates is there are market participants and there are market people that believe what the Fed is doing will somehow cause investment prices to go down because they believe that the Fed going through all this easing to begin with is the only thing that made investment prices go up. That is a falsehood. Investment prices didn't go up because the Fed created money and made them go up. Investment prices went up because corporations are continuing to use technology and productivity to become much more profitable. They've become very good at generating excess cash flow. They've become very good at having, for the most part, really nice balance sheets. And it's the productivity, it's the increase in earnings, it's the increase in cash flow that makes companies more valuable, which is why prices are up since the 08-09 economic and investment crash. They're up because the companies are doing well. And they're not doing well only because the Fed's easy on credit. They're doing well because they're productive and they're making good investment decisions. The world economy is continuing to grow. They're selling, for the most part, more product, and they're generating more cash. So the market isn't necessarily going to turn around and go down now because of what the Fed is doing. It's like there's a belief out there that, well, the Fed turns a knob when they want stock prices and bond prices to go up, and they turn a knob now, stock and bond prices will go down. Not true. So as I said a few minutes ago, I think the thing for people to understand is the Fed's action is going to be neutral to the investment markets, if anything, a very slight positive. So we'll go on to the next most important thing that is having a very big effect on investment markets, and that is the complete collapse in energy prices as well as other material prices. We talked about it just a few minutes ago in our segment about the economy. This is a situation where oil prices have become hostage to moderate OPEC countries who are trying to force down the price of oil as low as they can in order to financially attempt to bankrupt ISIS and bankrupt Al-Qaeda and people who are just as big a threat, maybe even bigger, to the moderate OPEC countries, Saudi Arabia, Kuwait, etc., as they are to us in the United States, as they are to France and Europe and most civilized people all over the world. So this is not a real fundamental thing. This is not a situation where the demand for energy has gone off a cliff. No, the worldwide demand for energy continues to go up. But for an investment standpoint, it has people somewhat correctly concerned that, well, is this going to cause some companies to go bankrupt? If oil goes to $30 a barrel, $25 a barrel, sure, it's going to bankrupt ISIS, and they're not going to have money to buy guns and bullets and bombs and pay mercenary fighters, but would it also create a situation where you're going to see some bankruptcies? Yes, probably will, and it's a disruptive force. But as I said before, this is actually good for investment prices. For every company that's dealing with energy, we can name 2 companies that having much lower energy prices is good for companies that manufacture and use a lot of energy. So some of the volatility we see, it's kind of a tug of war between people that one day get to looking at the companies like airlines that are going to be much more profitable because they're paying such a low price for energy, versus the companies that are in the business of selling supplies to energy companies, or actually producing energy itself. Certainly is a negative to them. So the markets have taken a little bit their extreme thinking. Somehow there's going to be a domino effect that the some of the energy companies may go bankrupt, and therefore if they go bankrupt, it'll be a domino effect. The banks that lend them money will go bankrupt, and then if they go bankrupt, other banks will go broke, and then other companies will go broke, and pretty soon they have this domino theory that, oh my gosh, everybody in the world is going to go bankrupt. No, it wasn't true about Greece. No, it wasn't true about China. And once again, no, that's not how this energy situation will play out. We are very surprised, and it's hurt our performance at Terril and Company this year, the complete collapse in the price of energy infrastructure companies. These are companies that don't produce energy, but own the pipelines and storage tanks that transport energy. Cash flow for these companies has not really fallen at all. Cash flow for these companies has actually gone up. But yet Wall Street has decided anybody in the energy business is terrible, sell them all, and prices of these things are down dramatically. We are still bullish longer term on these companies that provide infrastructure assets, and we are waiting, trying to see, are these things ever going to make a bottom? Because if we do think they've made a bottom, they should be bought, and bought aggressively. A similar thing could be said about some of the companies this year, and it seems that this year more than others, there's a tremendous amount of tax loss selling going on at the end of the year. Companies that are down in price this year are being sold aggressively here at the end of the year, as people evidently want to lock in their tax losses, and therefore stocks that are already down are going down even more. There are bargains there. There are stocks that are well overdone that should not be trading as low as they are right now. So in general, we are thinking that it's going to be a rough road in investments in the next 6 months until some of this transitionary phase that the economy is in can play out, until people become convinced that the world isn't coming to an end, because we've seen a collapse in material prices, copper and such things, along with energy. And longer than 6 months out, we become a little bit more bullish, and we think that we'll get pretty good opportunities to buy investments here between now and year end, and even in the first part of next year, even though we don't think in the next 6 months investment markets are going to make much progress. Recently, because of people's concerns about a credit crunch, you've seen bond prices really stumble and go lower. Again, this is a time frame when people are so worried. I think there's some irrational decisions being made by people of sell everything and don't ask questions. So again, we find that there's good value in some of these bond prices that have gone down, fixed income prices that have gone down. We want to continue to see and begin to accumulate more of that. Floating rate issues we think are a good buy. As the Fed does raise interest rates in the next year, interest on floating rate paper will go up. in a simple case, makes them more attractive, and we think there's some value there. So in general, Brian, it's been a lousy year in 2015, putting up with all of this volatility and the moves one way or another. But we're optimistic now that for the first time in quite some time, there are good bargains to be had that I think will improve our performance and make things look much better in 2016. And with that said, we'll go to a closure, Brian. We thank you for joining us this afternoon on our periodic update. Once again, my name is Joe Terril, President of Terril & Company, Independent Wealth Managers in St. Louis, Missouri. Brian, thank you for your help, and we wish everyone the very best for the holidays, and a happy holiday and a safe holiday season, and encourage our clients and interested parties. If you do have concerns, if you do want maybe a further explanation on our thinking or what's going on, please don't hesitate to call us or email us or text us or any of the numerous methods we have now of communicating with each other. Thank you very much, and we'll be back right after the first year to update thoughts again.